You're sitting in your car in the work parking lot. Not because you forgot something, because you opened your banking app while the engine was still running. It's just a quick check, 30 seconds, and now you need a moment before you go in. The number is fine, it's always fine, it's just never quite as fine as you'd like, and you can't entirely explain why, because by every reasonable measure, you're doing okay. Good job, decent salary, you got a raise last year, you're not reckless with money, and yet the number is always just fine. Now, picture your coworker, same office, same job title, same $63,000 starting salary, same Tuesday all hands where the VP of something says alignment 11 times and nobody writes anything down. You both got a $5,000 raise in year 2. You did what most reasonable people do. Moved to the apartment with the courtyard, traded in the 2014 Corolla with the peeling door handle, added a couple of streaming services because honestly you were sharing passwords and that whole thing got complicated. Life got measurably better, you earned it. She kept the parking lot apartment, kept the Corolla, kept packing lunch in the same blue container, but she opened her brokerage app and did something aggressive. She decided to live on her 2014 salary and invest every single dollar of every raise she got for the next decade. She maxed out her 401k, her IRA, and dumped the rest into a brokerage account. Fast forward 15 years, same company, same salary trajectory, you're in the parking lot doing the mental math before going in. She gets an automated email from her brokerage. Her portfolio generated roughly $4,800 last month on average. Her paycheck, it was $5,250. Same starting line, same raises. One of you is being paid by your employer. The other is almost entirely being paid by her past decisions. Same starting line, same raises. One of you is being paid by your employer. The other is being paid by her past decisions. My name is Nick, and I've spent way too much time thinking about why most people never reach this moment, even though they absolutely could. If you've ever looked at your investment account and wondered if it's ever actually going to do anything meaningful, like subscribe, hit the like button, because today we're doing the math that nobody shows you. There's actually a number for this. There's not a vague goal. A specific, back-tested, historically validated number. It comes from something called the 4% rule. Financial researcher William Bengen spent years backtesting every 30-year market period since the 1920s, but including the Great Depression, the 1970s stagflation disaster, the dot-com implosion. His conclusion: if you withdraw 4% of your portfolio per year, you have an overwhelming historical probability of never running out of money across a 30-year retirement, even in the worst market environments of the last century. What this means practically is simple. If you want investments to replace a $60,000 salary, you need a portfolio worth 25 times $60,000. That's $1.5 million. To replace $80,000, you need $2 million. To replace $100,000, you need $2.5 million. $1.5 million invested in a broad index fund, withdrawing 4% per year, generates $60,000 annually, indefinitely, without meaningfully touching the principal underneath. The portfolio is still growing, skimming the returns. Here's something Charlie Munger said that I find myself thinking about way more than is probably normal. He said, "The first $100,000 is a bitch," direct quote. He wasn't being colorful for the sake of it. He was describing something that is mathematically provably true. When you have $5,000 invested at 7% annual returns, your portfolio generates $350 that year. $350. You'd recover that faster by canceling 2 subscriptions and making coffee at home for a month. The investment returns feel completely pointless at small portfolio sizes because, numerically, they are. At $50,000, you're generating $3,500 a year. Not nothing, but still feels like a rounding error. At $100,000, that same 7% produces $7,000 per year without you contributing a single new dollar. At $300,000, your portfolio is generating $21,000 annually. At $500,000, Darcy's throwing off $35,000 a year, which is more than the starting salary at a lot of jobs, by the way, being generated entirely while you sleep, sit in traffic, or watch television. At $1 million, your portfolio produces $70,000 per year. It's officially employing itself. After 20 years, you're at $521,000. You contributed $240,000. The other $281,000, more than everything you ever deposited, came from returns. The portfolio is now producing more than you are. After 30 years, the total hits roughly $1.2 million. You put in $360,000 over those 3 decades. The remaining $860,000, the market generated that. You didn't earn it. You didn't negotiate for it. You didn't sit in a performance review and make a case for it. It accumulated while you were doing literally everything else with your life. Here's the part that doesn't feel real. In just the final decade of that 30 years, your portfolio balance grows by roughly $680,000. In 10 years, your actual contributions in that same period were only $120,000. That means the market generated $560,000 of that growth. You didn't earn it. You didn't negotiate for it. It accumulated while you were doing literally everything else with your life. The portfolio is producing wealth nearly 5 times faster than you are saving it. Let's put some numbers behind the parking lot feeling. Say you're 34, making $78,000 a year, which is solidly above median, nothing to complain about. You've got a 401k you contribute 6% to because the company matches 3%, and you're not leaving free money on the table. You drive a 2023 Honda CR-V financed at $524 a month. Nice apartment, not extravagant, $1,650 in rent. Dinner out a couple of times a week, 1 real vacation a year, standard streaming subscriptions. You have never once felt like you were being reckless with money. Here's where the money goes. Rent, $1,650, car payment, $524, car insurance, $180, student loans from the degree that got you the job, $320, phone bill, $95, streaming and subscriptions, you counted once and were mildly horrified, $127, groceries, $450, gas, $160, health insurance premiums your employer doesn't fully cover, $220, gym membership you use about 3 times a week, which is actually pretty good, $45. Utilities, $140. We're at $3,911 before you've eaten a single restaurant meal, bought a single item of clothing, or done anything that could reasonably be described as fun. You have $989 left. Your 401k contribution comes out pre-tax, already gone before the take-home hits. You're putting away about $390 per month into investments, which is not nothing. But at $390 per month at 7% returns, you reach the crossover point, where your portfolio generates $78,000 per year. In approximately 43 years, you'll be 77. That's not a retirement plan. That's a description of dying at your desk. And it feels like checking your bank account before buying coffee. Yeah, just a quick glance just to confirm every single morning without realizing you've made it a ritual. It feels like a low-grade anxiety that lives in your chest from the 25th of the month until the deposit clears. It feels like your car making a noise you don't recognize, and your first thought not being, I wonder what that is, but I wonder how much that is. It feels like doing rough math in the grocery store and then putting something back anyway. It feels like watching a coworker book a trip to Portugal and doing the math on whether you could technically afford the flights, and deciding you probably shouldn't right now. Because what if something comes up? Yeah, what if something comes up is the background operating system of being one unexpected expense away from a bad month turning into a bad quarter. The HVAC goes out in August. That's $4,000. Someone taps your bumper and your deductible is $1,000. That's a credit card. Your dentist finds something that needs a crown and your insurance covers 50%. That's another card. And suddenly you're spending the next 14 months paying off 3 things that happened in one bad week, while simultaneously failing to invest anything, while simultaneously watching the window where compound interest works best close another month. The single variable that determines whether you ever reach the crossover isn't your income. It's your savings rate. If you save 10% of your income, which to be clear is more than the US national average of 4.9%, You reach financial independence in approximately 51 years, longer than most working careers. You will, mathematically speaking, it's almost certainly not cross the point before you have to retire anyway. Save 25%. You get there in about 32 years. Better, but still most of your working life. Save 50%, 17 years. You could start at 28 and cross the point before you turn 50. Save 75%, 7 years. I want you to sit with that last one for a second. The difference between saving 10% and saving 50% isn't about how much money you have. And the teacher who saves 50% of a $55,000 salary reaches financial independence in roughly 17 years. The cardiovascular surgeon saving 10% of a $400,000 salary needs over 50 years. The surgeon earns almost 8 times more money and still loses because the savings rate does two things simultaneously. It grows your portfolio faster and it lowers the amount you need to be free. The teacher's 25 times target on $27,500 in annual spending is $687,500. On the surgeon's 25 times target on $360,000 in annual spending is $9 million. The people we've collectively decided can't afford classroom supplies are quietly out investing people who drive Teslas to work. And the reason isn't income. It's the gap between earning and spending. If you got a raise last year and spent all of it, that is not a character flaw. That is Tuesday. The entire consumer economy, every advertisement you've ever seen, like every apartment building designed to look slightly nicer than the one before it. Every car dealership with monthly payment math designed to make a $55,000 vehicle sound like $649 is precision engineered to consume exactly as much as you make. You are not undisciplined. You are just not playing a game anyone bothered to explain the rules to. Here's how lifestyle inflation actually happens because it's not dramatic. You don't wake up one morning and decide to be financially reckless. It migrates. You get the raise and you move to the nicer apartment because the lease was up anyway. You trade in the car because the payments were almost the same and the new one has backup cameras. You start saying yes to restaurants you used to skip, not because you're splurging, but because you can actually afford it now. Each individual decision is completely reasonable. Together, they've built a lifestyle that now requires your entire salary to function. The raise didn't make you richer, it just made your floor higher. Research found that the average American has 12 paid subscriptions but thinks they have 9. They underestimate their own subscription spending by 27%. And that's just subscriptions, the most trackable, most visible category of spending. Add the apartment upgrade, the car payment, the dining out habit, the clothing budget that quietly expanded, and you've got a perfect machine for turning income into a lifestyle with no leftovers. Meanwhile, back in your office, your coworker's portfolio just crossed $400 a month in returns, then $700, then $1,100. Her paycheck hasn't changed. Her employer's leverage over her has. Your salary gets hit with federal income tax, up to 37% in the top brackets. Then FICA, Social Security, and Medicare, another 7.65% on top. By the time you're earning a reasonable middle-class salary, you're handing over 28 to 32 cents of every new dollar to various levels of government before you've bought a single thing. The government calls this earned income, which, given how aggressively it gets taxed relative to everything else, is an interesting choice of words. Investment income. Qualified dividends and long-term capital gains are taxed at 0%, 15%, or 20% depending on your total income. No FICA, no Social Security surcharge, and no Medicare levy, unless you're earning well into high-income territory. Here's what that looks like when you run the actual numbers. A married couple living on $100,000 in salary income pays roughly $11,500 in federal income taxes. That same married couple living on $100,000 from qualified dividends and long-term capital gains in 2026, they pay $0 in federal income tax. Like the long-term capital gain 0% bracket extends to roughly $94,000 in taxable income for married filers, and the standard deduction sits on top of that. They don't come close to owing anything. 0 on $100,000 because the money came from owning things rather than doing things. Sit with that for a second. The IRS taxes you at 22% for setting an alarm and going somewhere every morning, and 0% for owning shares while you sleep. I'm not saying the system is rigged. I'm saying the system is extremely specific about who it rewards. And people who reach the crossover point, even partially, land on the right side of that specificity. The crossover point is not a magic switch. Reaching it doesn't automatically produce a great life any more than getting married automatically produces a great marriage. The research on what actually happens to people who reach full financial independence is genuinely surprising and a little humbling. Rowe Price studied nearly 3,000 people who had reached financial independence. 57% of them wanted to continue working in some form. Not because they ran out of money, because they ran out of structure. They underestimated how much of their identity, daily purpose, and social connection was wrapped up in their career. There's a syndrome in FI forms called one more year, the compulsion to keep working even after you've hit your number, because the question of what you'd actually do with your time turns out to be harder than the question of how to fund it. Blogger after blogger has written some version of the same post. I hit my number, I quit, and I had no idea what to do with myself. And here's something even more uncomfortable. A not small percentage of the people who write enthusiastically about financial independence are generating meaningful income from writing about financial independence, which is fine. It's honest work, but it means the story you hear is often told by people who replace their salary with a new career that they happen to love. The version where someone retires to nothing and figures out the rest is less frequently published. The most satisfied people who cross the point share one trait. They retired to something, not just from something. A project they'd been postponing, a business they'd been afraid to start, yet a role in a nonprofit they couldn't afford to take, a slower version of their existing career on terms they actually chose. They use the crossover as a launch pad, not a finish line. Here's what the research on money and happiness keeps arriving at over and over. 74% of the relationship between money and life satisfaction comes down to a single variable, the extent to which you feel in control of your own life, not what you own, not your net worth on paper, how much agency you feel over your own decisions. The crossover point is, at its core, a control event, not a retirement event. A control event. Here's the realistic picture of where most people actually are. The US national savings rate is 4.9%. At that rate, financial independence takes longer than a working career. You'll be collecting Social Security before your portfolio could plausibly replace it. Half of all adults under 34 aren't saving at all. The median 401k balance across all ages in America is $38,176. At 7% returns, that generates about $2,672 per year. That's $222 per month. Most people's grocery bill for 2 weeks. Nearly 40% of Americans can't cover a $1,000 emergency from savings. Not because they don't earn enough. Surveys consistently find that significant percentages of people earning $200,000 and even $500,000 a year describe themselves as living paycheck to paycheck. This is not an income problem. It's a savings rate problem wearing an income problem's clothing. The first lever is also the one everyone already knows about and almost nobody actually uses. Start now. If you invest $500 per month beginning at 25, you'll have roughly $1.3 million by 65. Start at 35 instead, just a decade later, contributing the exact same amount. And you end up with about $610,000. The 10-year delay costs you $700,000 despite only contributing $60,000 less. The math on timing is almost violently unforgiving. Every year you wait doesn't just add a year to the timeline, it removes a compounding year from the end where the portfolio would have been doing the heaviest lifting. The second lever is the uncomfortable one, not 5%, not 8%, Those numbers are better than nothing, but they don't get you to the crossover in any time frame that changes your actual life. The honest target for crossing the point before traditional retirement age is 20 to 30% or more. That feels impossible for most budgets right now, and for a lot of people, it genuinely is. But for a lot of people, it just requires a brutal audit of the lifestyle inflation that crept in over the last few raises. The third lever sounds passive because it is, and that is entirely the point. Leave the money alone. The S&P 500 has returned roughly 10% annually over a century. It's also crashed 30, 40, 50% multiple times within that same century. People who stayed invested through every crash, including the terrifying ones, captured those long-run returns. People who sold in a panic locked in the loss and missed the recovery. The portfolio can't do its job if you keep interrupting it. Your employer's leverage over you isn't your job title. It's not your performance reviews or your years of service or your specialized skill set. Their leverage over you is your bank account balance. Specifically, whether you need next month's paycheck to cover next month's rent. That's it. That's the entire power structure of employment, stripped down to its mechanism. As long as that's true, you work on their terms. The moment it stops being true, the moment your portfolio could cover your life for months or years without a new deposit, the whole equation changes. You don't have to reach the crossover to feel this shift. You feel it when you have 6 months of expenses saved and you stop flinching every time the company announces a reorganization. You feel it when you have $200,000 invested and you realize you can negotiate your salary without your heart rate spiking. You feel it in the way you walk into a performance review differently when you have genuinely considered what you'd do if you walked out. Financial independence, full crossover, complete salary replacement, that's the end of the road. But the road itself changes the whole experience of working every single step of the way. The people who build real wealth aren't necessarily the highest earners in the room. The Ramsey Solutions study of 10,000 millionaires found that 79% received no inheritance, 80% came from families at or below middle income, and 1 in 3 never made $100,000 in a single year of their careers. The top careers of American millionaires: engineer, accountant, and teacher. The people we keep telling to do it for the love of it are doing it for the love of it, and quietly building net worths that would embarrass their 6-figure colleagues who spent the raises. Your coworker didn't do anything heroic. She drove the same car, ate the same lunch, lived in the same apartment while you upgraded yours. The only decision she made differently was treating the raise like it belonged to her future instead of her present. And 15 years later, her portfolio sent her a number bigger than her paycheck. That's the whole story. That's the entire thing. They just ran the math that nobody tells you to run. They saved the percentage that feels inconvenient. They let compound growth do the work that they refused to do themselves, spending every dollar before it could multiply. And one morning, they opened their brokerage app and saw a number that was bigger than their paycheck. That's the crossover, and it doesn't happen to lucky people. It happens to people who treated a $5,000 raise like it didn't exist, opened a brokerage app instead of an apartment listing, and then waited long enough for the math to catch up. You can't rush compound interest, but you absolutely can start it. And starting it today is worth more than starting it perfectly tomorrow.